Okay, welcome. We are now on part 7 of General Equilibrium on NyQuil, where we're talking about the welfare costs of inflation. So, with the previous two lectures that I gave, both were on dynamic general equilibrium models of money. The first one went through the problem setup, we got our Euler equations, we looked at some steady states, which fed into the second lecture, which kind of wrapped some stuff up on steady states. Now, once we did that and we kind of learned how monetary neutrality can apply in this class of models, we can now talk about the welfare costs of inflation because monetary neutrality doesn't assume that changes in inflation will have no effect on real variables, because it will. Right? We're not assuming that there are not welfare costs to inflation. We're just saying that changes in the money stock or the growth rate of money won't be affecting real economic variables. So inflation's got welfare costs. Let's just get that part out of the way right now. Higher inflation reduces real money balances, and that generates a welfare loss for society. So there are two questions now. One, is there an optimal rate of inflation for this model? Two, how big's the welfare loss? Now, we kind of already answered both of these in like a partial equilibrium framework, but now we get to do it in a general equilibrium framework, which is awesome, as this is really where we can actually use pretty solid macroeconomic models and apply them to like real world statistical models, which, use actual data. And we can kind of marry the two and check, make sure, hey, do the theories applied in this model actually match what we see in the data? It's good stuff. So, we're going to go at this one by one. First, let's go back to what Milton Friedman said. And what did Milton Friedman say? Well, he said a lot of really cool things over the years. However, in this case, he said the private opportunity cost of holding money depends on the nominal interest rate. Now, the social marginal cost of printing money was essentially zero, because if you got like the money printer going brrr or whatever, that meme is now. I don't know what all you kids are doing these days. I'm an old man. I'm an old fart. The social marginal cost of producing an additional unit of money is basically zero. That money printer's going. If you've printed, say, $1 trillion and you want to print one more dollar, right? The cost of printing that additional dollar is basically zero. Honestly, it would probably cost more just to shut the machine down, wrap everything up, than it would to just let the printer go a little bit longer. So it's basically zero. Now, we've gone through that in great detail, borderline ad nauseum at this point. But remember, there's a wedge that gets created between that private marginal cost and the social marginal cost. And if we think of the opportunity cost of holding money essentially being like the price of holding money, right, where, say, the interest rate we can be thought of as the price of money, then a positive nominal interest rate being larger than zero is creating an inefficiency, because we can think of the price being greater than marginal cost. And if you remember from microeconomics, in a perfectly competitive environment, price equals marginal cost, like the most efficient possible outcome that you can get in that particular market. Now, you may stop me and go, whoa, Jeremy, but I thought the central bank had a monopoly on money. It does. But it doesn't mean they can't price at marginal cost. I guess theoretically they would, produce up to where marginal cost equals marginal revenue, and then they would price on the demand curve, whatever. Let's just set price equal to marginal cost. When price is greater than marginal cost, there's an efficiency, or there's inefficiency. Blah, blah, blah. Sound it out, Jeremy. Now, we could eliminate that inefficiency if the private opportunity cost was also zero, which produces a case where the nominal interest rate is zero. Cool. So by the Fisher equation, remember, the real interest rate equals the difference between the nominal interest rate and the rate of inflation. So when the nominal interest rate is set equal to zero, you have a real rate of interest equal to the rate of deflation of money. So that essentially makes you indifferent between holding bonds or holding money. Because if you want to hold money, you get liquidity, you can buy things with it, right? That's awesome, it's great stuff. But the problem is you're buying things, or as you're holding money to be able to buy things, that money is losing value because of the rate of inflation. Meanwhile, bonds are generating a positive rate of return, right? There's a positive real interest rate. So as we have this like sort of like imbalance, right? Because bonds are helping you earn money and money is helping you lose money. If the nominal interest rate is zero, we have a rate of deflation equal to the real interest rate. So money is gaining value at the same rate that you are earning money on holding these bonds. And thus you are indifferent between which one you choose to hold, and that is, according to Friedman, the socially optimal rate of inflation. So the rate of inflation that's optimal in this model is actually a rate of deflation equal to the real return on capital. So if you think about it, right, this stuff really isn't any different than what we learned before. It's just now it's in a general equilibrium framework. So in partial, right, you've got one individual market. In general, you've got a bunch of markets. And when you got all these markets in general, right, you change something that happens in one market, it can screw up what happens in the other. And in this case, right, even though we've got a general equilibrium framework, we still have a situation where a zero nominal interest rate is the most efficient possible outcome we can get, at least when it comes to an optimal rate of inflation. So we can think of the government choosing its policy instruments, say steady state inflation, to achieve a steady state optimal value of money growth, real money growth, right? So we go back to what Friedman said, and when we apply it to models of this type, namely some kind of dynamic general equilibrium model with money in it, or a money in the utility function model, which I'll have another lecture of that coming up, and then we can get into some more interesting stuff after that. Steady state utility gets maximized subject to this constraint. So this constraint isn't any different than what we saw before, right? C equals Y minus I. Steady state consumption equals steady state output minus steady state investment. But remember, steady state consumption is independent of steady state inflation. So the first order condition for the optimal rate of inflation is U of CSS equals 0. And that gets achieved when we have a zero nominal interest rate. But there are criticisms to this, and these criticisms are, in fact, particularly valid. And he's like, I can be fairly dismissive of a lot of economic models that generally, advocate more intervention. However, that doesn't mean that like all models that advocate intervention are bad. In fact, many of them are quite good. A lot of new Keynesian models are absolutely fantastic. In fact, I would argue that new Keynesian models are better than this class of models, more like a real business cycle model that we're looking at here. But anyways, there are criticisms to this type of model. Phelps in 1973 had a major criticism, and like I said, this is a fairly reasonable argument, which we can talk about in the next slide. So in 1973, Phelps argued that money growth generates revenue for the government. It's called the inflation tax. Now, we currently assume that taxes were non-distortionary, but let's assume they were distortionary, like a marginal income tax or something of that nature. Instead of a lump sum transfer, right, you could have, say, a tax on wage earnings, right, or like an income tax, or maybe something like tau times y. When we maximize our utility, taxes would not differentiate to zero because they would be multiplied by one of the variables that we're interested in. So if the government only has distortionary taxes available for financing expenditures, right? What do I mean by that? Well, what I mean is that at the margin, tax rates are going to begin to matter. Whereas previously with lump sum taxes, they don't matter at the margin. But if we have some kind of a marginal income tax, well, like I said, marginal is going to be affecting things at the margin. And if the government has distortionary taxes available for financing their expenditures, if they were to reduce the inflation tax by setting the nominal interest rate equals to zero, it's going to mean lost revenue from inflation, which has to be made up for by increasing taxes. So to minimize total distortions, it would be optimal to rely on the inflation tax just a little bit. The idea would be having a little inflation means that we don't have to be explicitly taxed by as much. Now, if we were to listen to Milton Friedman, kind of try to kick back at this one a little bit, what he would say is, okay, let's say there's inflation. Now, if if prices increase by 10%, which, 2 years ago, you would have been like, oh my God, 10% inflation? Now it's like almost the norm. It's really sad. But if we were to have, say, 10% inflation, well, your wages would have to increase by 10% in order to be able to offset this change that we have in the price level, because prices have increased by 10%. So in order to be like made just as well off as you were before, your wages would have to increase by 10% as well. But a little bit of a problem here, right? Initially, you'd think, okay, well, I'm no better off than I was before. I'm no worse off than I was before. But in fact, you actually are worse off, according to Friedman. And this is an argument I really can't knock too much. It's pretty solid. Think about the marginal tax rates. If tax rates don't go up, and what I mean by tax rate is actually the tax bracket. Okay, so like you earn from, I don't know, I'm just going to pull numbers completely out of thin air, but let's say, if you earn less than, I think, like $160,000 a year, it's like 24% marginal income tax or something at the highest, and then you go above 160, it's like 32 or something like that. I don't really know. Let's say you go from earning $150,000 to $165,000 a year. Well, if that tax bracket isn't raised, you are now being taxed at a higher rate because you went above $160,000. So inflation actually is a tax because it can essentially allow the government to extract higher tax rates from you, thus they can get more money out of you. So if your income goes up by 10% to offset that 10% rate of inflation, and tax brackets aren't adjusted accordingly, you end up paying more in taxes, so your wages would have to increase by more. So that's where inflation really is sort of a tax. But what Phelps is arguing here is something that's a little bit different than that, because there is such a thing as monetizing the debt. And if we were to monetize the debt, we're essentially inflating our debt away. If you owe $100 right now, and we are at 10% inflation, cool. Not really. 10% inflation sucks. But we're just assuming, right? Let's say you don't make any payments right now. Payments start up next year. Well, 1 year from today, right, you still owe in nominal terms $100. But the rate of inflation went up somewhat substantially. Thus, in real terms, right, when you pay back that $100, you're not paying back that $100 in real terms that you initially had to owe. You actually owe in real terms less than that because inflation eroded away the value of that $100. So, as such, if the government owes a lot of money on its debt, let's say, and they can print more money, well, a benefit of inflation is that it actually erodes away the real value of the government debt just a little bit, just a hair. However, in either situation, however you want to think about it, inflation is a hidden tax because it is extracting resources from consumers, and it is a wealth transfer, right? It is not even just a wealth transfer, it's just a transfer of resources from one party, one agent in the economy to another agent in the economy. So regardless of how you want to look at inflation, it is in fact a tax. Now, how big are these welfare losses from inflation? Well, these welfare costs can be calculated by the area under the money demand curve. Right? If you think about welfare costs in microeconomics, right, it's the area under the demand curve. Now, money is a function of the nominal interest rate, and it can show us the lost consumer surplus from having a high nominal interest rate, right? In microeconomics, it would be the lost consumer surplus from having a high price, a price that is above marginal cost. So if we assume price should be equal to marginal cost, in this case, that would be 0%. That's what the price should be. But let's say the nominal interest rate is just shy of 40%. Now, that's pretty high. And, I took this screenshot out of a textbook. It was Carl Walsh's monetary economics textbook. Used it for grad school. Great stuff. But if this is our money demand curve and the nominal interest rate is set at just below 40%, the welfare cost, right, is everything from this horizontal line down under the demand curve. And the nominal interest rate, remember, it reflects expected inflation. Because remember, if expected inflation goes up, nominal interest rates will have to rise as well because, well, if I'm making a loan to you and I expect inflation to be quite high, I'm going to have to set a high nominal interest rate in order to have a positive real interest rate on that, right? Because if I expect inflation to be 10% and I charge you 5% nominal interest rate, well, I'm screwed because I end up losing out because there's a negative real interest rate that, well, it's negative. So I end up losing money by lending you money. So if we were to calculate the area under the money demand curve, it's going to give us a clear idea of the costs of anticipated or really expected inflation. Thus, it's a good idea to evaluate the costs of the alternative constant rates of inflation. Kind of like, okay, if inflation's constant, this is going to give us like a baseline, and then we can think about deviations from the baseline. Now, there are other costs that are also associated with tax distortions with the variability of the interest rate too. Relative price distortions can also be generated by inflation. This is more the case with like sticky prices where we get into like a new Keynesian model. However, if there is some shock to the money supply increases by a certain amount and not all prices adjust instantaneously. Well, let's say you typically buy, I don't know, gasoline and Subway sandwiches. Well, if the price of gas goes up before Subway sandwiches go up, then you end up having to pay more for gas relative to Subway sandwiches. So that relative price gets distorted, which affects your real purchasing power, which has welfare costs associated with it. But like I said, that's more with sticky prices, which we'll be getting into very, very soon. And what's cool, though, is Robert Lucas came up with a great way to figure this out, where he calculated the welfare loss from a nominal interest rate of 10% and figured that it would be about 0.013, or just above, slightly above, 1% of aggregate consumption. So think about that for a minute. Maybe 1% of aggregate consumption isn't a huge deal, but okay, it's big enough to be a minor nuisance. So for every $1 you spend, or $100 you spend, $1 of it is lost, which kind of sucks, right? Kind of a little bit of a bummer. So this is going to wrap up the lecture on welfare costs from inflation. There will be a couple more lectures coming, of course. We're not quite done with the course yet. But in the meantime, thank you for watching, and I will see you next time when we talk about more monetary economics, but we do it on NyQuil. Thank you for watching.